All right, let's dive in. Today, we're going to unpack three massive stories that are hitting the fintech world all at once. You've got these huge tech partnerships, you've got old-school legacy players making some pretty shocking crypto moves, and then, on top of all that, a major shift from the Federal Reserve. So let's kick things off with a team-up that, honestly, nobody really saw coming.
This is just perfect, right? Think about it. Taco Bell and KFC sharing a building. You didn't ask for it, but hey, it kind of makes sense. And that is exactly the kind of energy we're seeing in fintech right now. We're talking about some really unexpected pairs, starting with two absolute giants who are, well, trying to get their groove back.
All right, first up, Big Tech's AI bet. This is all about a massive team-up between Google and PayPal. And spoiler alert, they are going all in on artificial intelligence to write their big comeback story.
So, to really get why this is happening, you got to understand where both of these companies are at. On one side, you've got PayPal. I mean, they were the OG of online payments, right? But lately, they've been losing ground to newer, slicker rivals like Stripe and Apple Pay. And then you have Google, a tech titan for sure, but let's be real, they haven't exactly crushed it in the fintech world. Anyone remember Google Wallet? Yeah. So this whole thing is kind of like two legendary athletes, maybe a little past their prime, deciding to start a podcast together. They're hoping they can team up and recapture some of that old magic.
So what's the game plan? What are they actually doing? Well, it's pretty straightforward, really. Think of it as a big trade. Google's basically plugging PayPal's tools, like its checkout and hyperwallet, right into its own world. You know, Google Cloud, the Play Store, the whole shebang. And what does PayPal get out of it? This is the big one. Access to Google's insane AI power. And for you, the user, the goal is a much smoother payment experience, especially when you're sending money across borders. AI is supposed to make all of that seamless.
And you know who was paying attention? Wall Street, of course. The second this news dropped, PayPal stock shot up over 3%. It's a huge vote of confidence, right? It tells you that investors are seeing this as PayPal grabbing onto a rocket ship, even if that rocket ship, hasn't quite figured out its exact flight path in the fintech universe just yet.
So the takeaway here is pretty simple. You've got these two, let's call them fintech misfits, who are hoping that by joining forces and throwing a ton of AI at the problem, they can turn this little joint venture into a real championship run.
Okay, so story number one is about two modern giants trying to innovate together. But our next story, wow, this one is about an old dog learning a very, very new trick. We're talking about a real legacy player, a name you've known for ages, MoneyGram, diving headfirst into crypto. I mean, who saw that coming?
And just look at this timeline to see how wild this really is. MoneyGram started back in 1940. 1940! For most of our lives, they've been the place you go to wire cash from a convenience store. And now, today, they're launching a stablecoin payments app on the Stellar blockchain. I mean, talk about a pivot. That's not just an evolution. That's a whole new species. Okay, hang on. Before we go any deeper, let's just do a super quick refresh on what a stablecoin even is, because it's important. Basically, it's a type of crypto, but its value is locked to something stable in the real world, usually the US dollar. So unlike Bitcoin, which can go on a roller coaster ride, a stablecoin is designed to stay, well, stable. This makes it way more useful for actually buying stuff or sending money.
So why is this actually a genius move for a company like MoneyGram? Well, think about what MoneyGram does best, sending money across borders, remittances. And that is like the absolute perfect use case for stablecoins. It's faster, it's way cheaper, and it's borderless. And the market is huge. Just in Colombia, 2.5 million people got money sent to them from abroad last year. But here's the real kicker. MoneyGram is using its old-school brand trust. If your grandma has trusted MoneyGram for 30 years to send cash, maybe, just maybe, she'll trust them with these new digital dollars too.
And that's really the bottom line here. Look, the hardcore crypto folks might laugh at this, but they're missing the point. When a company that your parents know, a household name like MoneyGram, jumps in, that's when you know stablecoins are no longer just some niche thing for tech nerds. They're becoming a real deal, mainstream financial tool that absolutely no one can afford to ignore anymore.
All right, for our third and final piece of this puzzle, we're going to zoom way out. We're moving from specific companies to the big, big picture, the entire economy. Because the Federal Reserve just did something that could change the whole game for everyone.
And here it is, a 1/4 percentage point cut to interest rates. Now that might not sound like a lot, but this is a huge deal. It's the first cut we've seen since 2024, and it's basically the Fed waving a flag saying, okay, the era of super high interest rates is starting to end.
So what does this mean for fintech? Why should they care? Well, it's pretty simple. Lower rates mean it's cheaper to borrow money. Cheaper credit means people are more likely to spend. And who loves that? Companies like SoFi, which do lending, and the buy now, pay later folks like Affirm. This is basically music to their ears. Plus, it takes a ton of pressure off of all those tech company valuations that have been getting squeezed by high rates.
But okay, let's not get ahead of ourselves here. The Fed chair, Jerome Powell, basically said, "Whoa, slow down. This is just a first step, a little test." I love how the source material put it. This is like Drake dropping a single, not the whole album. He's just seeing how people react. So yeah, it's a good sign, but we're talking about a slow burn, not a wildfire.
But even with that caution, the takeaway is crystal clear. This rate cut, this is the green light that the entire fintech world has been holding its breath, just praying for. It feels like the financial pipes have been clogged for years, and someone just finally came in and cleared them out. It just creates a so much healthier environment for these companies to grow.
So let's pull all three of these threads together. We've looked at a big tech team up, a legacy player going crypto, and a major shift from the Fed. They seem like separate things, right? But when you put them all together, you get this really amazing snapshot of what's happening in fintech right now.
So, what are the three big trends to watch? Here they are. First, AI collaboration. You've got these huge incumbents partnering up, basically betting the farm on AI to stay relevant. Second, legacy innovation. Who would have thought? Old school players like MoneyGram are actually adopting cutting-edge crypto to solve real-world problems. And third, the market shift. The whole economic backdrop is changing, and the Fed's move is creating this massive tailwind that could lift the entire industry.
And that brings us to the big final question. You've got these three huge forces all pushing and pulling at the same time. So what's going to define the next chapter for fintech? Is it going to be the clever partnerships, the crazy new tech, or is it just the simple fact that the economic winds have finally changed direction? That right there is the story we're all going to be watching. Thanks for tuning in.